everyone. Thanks so much for joining us today, joining the Generation Income Properties team as we host our first webinar on what is an UPREIT. We are excited that you've joined us. We appreciate your time. I'm Bobby Rohrlach, Generation Income Properties Acquisitions Manager, joined today by Dave Sobelman, Generation Income Properties CEO. We're going to be sharing just that, what is an UPREIT, talking through the transaction, the structure, some of the benefits of completing an UPREIT and why it could be a great solution for property owners. So again, thank you. There will be an online Q&A session at the end of this, so please send across questions as they come up. We are recording this as well, so this will be publicly shared afterwards, as well as the presentation that we're going to be walking through during the webinar. So thank you again. And with that, I will hand it over to Dave to kick us off.
Bobby, thank you. Thank you, everyone, for joining us today. It's so nice to see some really familiar names and some brand new names. And we're just excited to let you know a little bit about what we're doing here and just about us in general. So let's get started. Of course, we're a public company, so we have a disclaimer here. You're going to get a copy of our slides afterwards, and you'll see what we're disclosing. What we're going to go over today is just who we are, what makes us different. I thought it'd be interesting for you to hear about what we're hearing in the market. We may have a little bit different perspective being a public company, so we wanted to share that insight with you. Of course, we've been marketing our UPREIT program. That's the intent of today's slides. And I also thought it'd be helpful for you to hear about our future. So who are we? So we are a NASDAQ company. Our symbol is GIPR. GIPR is what a lot of people call us. And if you don't know that reference, please look it up. I'm old enough to know it. I think I'm the only net lease REIT CEO that comes from a net lease brokerage background. We're going to talk about that today because I think I have a little different perspective on the market, and we instill some of that into our company. There's about 200 REITs right now. Our REIT started really as a concept, literally at zero. And this is where we are today, and we hope to be much larger than that. But we purchase retail, industrial, medical, and office properties. Here's my glamour shot here. There's been a big fight on which picture to use, but I thought it was important to let you know who's leading our company. I truly understand how you feel. If you are a broker right now, I have been in your shoes, especially in a down market. And so what you're trying to do is show value to your clients. You want your clients to say, wow, you're really doing a good job. You're thinking out of the box, so to speak. And let's face it, low transaction volume is not helping anyone right now. So our entire company understands that. We discuss it. And one of the reasons why we're doing this webinar today is to maybe have a solution for you. We are big on culture. I know a lot of people talk about culture. This is something that we address probably 2 to 5 times per week. The famous business author Peter Drucker says, culture eats strategy for breakfast. That means culture comes before strategy. And we have a big emphasis of culture. To summarize what our culture is in one word, it's care. And you're going to hear that throughout our slides. There's a very wise man who once said that being a good example is not good enough. And we have to live out our culture in every interaction we have. We're based on theological fundamentals that resonates throughout our entire company. Every interaction we have, every conversation we have, every email that we send is very thoughtfully and with care sent to that individual. Our goal is to outperform other traditional net lease REITs, and we're doing that with a very small team. And that is based on our culture, our high-performing employees. We invest in them constantly, and that includes myself. and we make sure that we can perform really well for our shareholders. We have 4 core values. Generational, of course, is in our name. I always say that I'm investing for my grandchildren, and my children are 16 and 14. And so we want to make sure that we have a very long-term outlook when we buy an asset. We are not property flippers. We're not looking to make a quick return on anything. We are traditionally buy and hold. We do sell occasionally or contemplate a sale, but mostly buy and hold. One core value that you're going to continually hear from us is that we're relational. Our relationships matter, not just to do deals, but we truly want to have non-contrived relationships within our industry. And that's something that you are going to continually feel and hear through working with us. Of course, we're ethical. We have an extremely high level of integrity, and we just want to make sure that we're doing the right things when no one's looking. We used to not talk about this 4th value because I thought it was a little arrogant, but we started to get more comfortable with it, being intelligent. I'm sure you want us to be intelligent. You want us to make good decisions. You want us to be thoughtful. And we actually get opinions from all different people inside our company, and everyone's opinion really matters and is thought of equally. We have a small team, but our mission is to improve the lives of all stakeholders for generations. So you're seeing pictures of our team here. This is our high-performing public net lease REIT, and everything that we've accomplished so far has been with a very small team. We're never going to have thousands of people working at GIPR. The business model just does not lend itself to that, and so we will continually to hire and grow and expand our stable of staff and management here with very high-performing people. So what makes us different? One of the reasons we started this company is because I saw something in the public net lease REIT space that there wasn't a REIT that was focused solely on short-term properties. And our WALT for the entire portfolio right now is 4.6 years. We have really high credit within our portfolio, and we actually care where our properties are located. The reason I'm laughing about that is because we're buying short-term lease properties. We're taking that risk that the tenant may leave, or they may ask for a rent reduction, or some circumstance within that property is just different from that new construction, long-term, triple net lease. And so we put a lot of emphasis on where our properties are located.
Well, thanks, Dave. I'm going to spend just a few moments here talking about this slide in front of you, and what the intent of this diagram is to show you all kind of how we analyze whether a property could be a fit for us. Now, simply said, generation income properties, we buy a variety of asset classes. We buy single tenant, retail, office, medical, and industrial. And through that requires a lot of different analysis as to whether or not a property could be a fit. Based on the actual asset and the tenant occupying that. But let's talk through kind of how we view whether or not maybe that property could work. So on the left-hand side, you'll see a pretty kind of clear and quick process as to why property would work for us based on our thesis. Is it investment grade? Does it have less than 8 years of term? Could be a great fit if it's a single tenant. What we also would like to show you all is that even if it doesn't check our primary criteria boxes, it still may work. Maybe it's a publicly traded company that doesn't have a traditional credit rating tied to it. That still could be a great option. One of the properties in our portfolio that we like to use as an example is a Lazy Boy property that we own. The Lazy Boy under the traditional rating of investment grade does not have a rating, but based on their financials, we deem them creditworthy. And so this has been an asset where on the surface, it doesn't check all of our boxes, but we really dove into it and underwrote it. It really was a good fit and has performed exceptionally well for us. So what we're trying to show here is, even if it's not maybe in every capacity what we're looking for, please send it to us. Again, our thesis does open up for a lot of different property types. and tenants. And so we appreciate the chance to review a property, even if you're unsure of whether or not it's a direct fit.
So like I said, I thought it was important to share some industry knowledge of what I'm hearing. I do make a point using our relational core value to speak to my CEO counterparts and other REITs, and whether they're net lease or otherwise. And so giving you some of that feedback and hearing it from an institutional owner, I thought would be really helpful. One of the things that I've summarized in my conversations is that we don't want to spend our investors' money in the wrong market. We don't want to make bad decisions. So you're going to continually hear words like patience and discipline. And those are things that you hear in earnings calls, in transcripts, in marketing materials. The reason is we don't want our investors to say that we're making bad decisions. And ultimately, what that means is we need to buy assets that work for our cost of capital, how much our equity is, what our debt rates are, combining those numbers and using them, backing into a cap rate that works for the cost of that capital is something that we are very focused on. All REITs are focused on, especially net REITs, because we have fairly thin margins or spreads between our cost of capital and our cap rates. So what's a possible solution for your clients? That's the purpose why we're here today, is the UPREIT. And you're probably saying to yourself, what is an UPREIT? It's an acronym for Umbrella Partnership Real Estate Investment Trust. And so that's just really a fancy way of saying that it's a different type of exchange. A contribution. So in a 1031 exchange, you do a traditional sale, you have your time period in between transactions, and you purchase another property to defer those capital gains. In a 721 exchange, a contribution, and I'm using the word contribution because that's a tax word. Sale is also a tax word. So a sale will trigger different capital gains treatment. Contributions also trigger different capital gains treatments. So if you are contributing property, and you eliminate that timing factor, which is very important. So there's not this anxiety-ridden transaction that you're about to have. It's a very open, disclosed, communicative process between you, the representative, and or the owner. And we get the ability to defer those capital gains just like you do in a 1031 exchange. How does it work? So we did this nice schematic here. You see at the top, you have the owner, landlord, or the contributor. Those are all the same parties. And the property is then contributed to GIPR, to GIPR. Just so you know, brokers are paid at that transaction, just like a traditional sale, the exact same timing. When that closes, brokers are paid. Even though there's no sale, the contribution does trigger the commission at that point. What does the contributor receive? And you see that we're changing the name from seller to contributor. They receive dividends, and there's tax advantages to getting dividends from our company as opposed to getting rent from a tenant. There's lower tax rate, essentially. Of course, they're deferring their capital gains tax. Now they have a diversified portfolio within our company, so they're getting all of our properties and not just their one property or small group of properties. And then we're going to talk about liquidity, future liquidity, and the option for potential liquidity. Lastly is growth. So we're a small net lease REIT. Our intent is to grow to be a much larger net lease REIT. So they'll get paid while we grow. Who's it for? We get this question a lot. So who is an actual candidate for a contribution for an UPREIT? Family-owned real estate. we all have been, as a broker, I know that families don't always agree on how they should be holding their assets. So families can contribute their properties to GIPR, and we allow them to go their separate ways at the transaction. Partnerships or funds, maybe they're not family and they're just partnerships, same thing, can contribute, partners go the separate ways. If you have a low tax basis, I know that's a big trigger for people to do a 1031 exchange. It's like, I can't sell this property and take the cash. I'll pay too much in taxes. The contribution works really nicely with that. Also, if you just have one asset or a small portfolio of assets, you're contributing your property or properties into a much larger pool of properties. Maybe you have some debt expiring. We replace that debt, assume your debt. The contributor no longer has any debt responsibilities at the close of that transaction. And also, we all know that net lease properties are supposed to be passive investments. We know as owners that they're not completely passive. And so if a landlord doesn't want to incur any of those phone calls anymore, we take that. And then developers. Developers' business model, traditionally, if they're emergent developers, to build and sell, build and sell, build and sell. There hasn't been a lot of one component of that now, which is the sell part. And so we've been speaking to developers a lot about making contributions to our portfolio.
And Dave, one component I'll add just for those on the webinar is for owners that are looking to estate plan, maybe it's for grandchildren, the process of going through the UPREIT and receiving the operating units, the equity from the contribution, that can be allocated to your kids or your grandkids. And so it sets up a really good long-term estate planning solution too, if you're looking to exit the property.
Mm-hmm. So why would you do an UPREIT? We're just going to recap what we've been discussing. You're deferring your capital gains taxes. You have future liquidity. What's also important here, we put in parentheses, in whole or in part. So if you want some cash and selling your shares at that point and not selling all of it, that is absolutely the contributor's choice on how much and when. The diversification, you're getting cash flow from dividends. People are doing estate planning, passive investing. But what I thought was really important is you want to show your client, if you are a broker, that there is a flexible option that does exist in today's market. You can help them provide an exit for them. You can relieve that client of debt obligations. There's a lower tax rate on dividends than on collecting rent. We're getting equity in a high growth trajectory company, deferring capital gains. Everything that I've mentioned before is all of the reasons why you would want to do a contribution.
So we'll talk through our process and really what it looks like as far as when a property is presented to GIPR and then how we give that feedback back to the broker and or the owner. Typically, our committee process to review an asset is 3 to 5 business days. We will commit to giving you all feedback within a full week. But generally, once an asset is presented, we do present that to our committee, which we are a relatively nimble committee, which we like. We appreciate having the quick flexibility and feedback on an asset. Our committee is comprised of Dave, our CEO, Emily Hewland, our Director of Capital Markets, and myself. And so once a property is sent, we really can get that feedback back to the broker and the owner fast and let you know how we're underwriting it and how we're viewing it. And if it is a fit and it's approved, more likely than not, a term sheet to then acquire the asset.
One thing I'd just like to add to that, Bobby, is that you will never hear hard-nosed negotiating from us. That goes back to our relational core value. We have a very simple business. We buy buildings at fair prices. We're not always paying the best price. We're not always paying the worst price. And we make sure that you understand that we have a very high probability of closing and that there's nice people on the other end of that transaction. So this was, Bobby just laughed, by the way, because this slide is kind of interesting. Why isn't every REIT doing this? So you may have heard other REITs doing this. My guess is you probably haven't. And the reason is because a lot of the other REITs don't want to do this. There's obviously costs, and it is a complex transaction. We take care of the complexity part. But the reason that most REITs don't want to do this or market the fact that they don't do this is, or market the fact that they would do this, is because we're raising capital. And when we do raise capital from investors, there's a pressure to use that capital in as fast a time period as possible. If we're doing an UPREIT or a contribution to our portfolio, we're not using our investors' capital. We're using other instruments for the equity for that. So we're not able to spend the raised capital as quickly, and the other REITs, the much larger REITs, have much more pressure on them to raise that, to spend that capital that they've raised. So it's really important for you to be able to explain to yourselves and potentially to your clients what our growth trajectory may be. What we're doing here is, we're all real estate people. Comparables or comps are really important to us. We outlined 3 retail net lease REITs here, ADCs, Agree, NetStreet, and Pine. In 2019, Agree had 789 assets. Today, they have probably over 2,200, let's say it's 2,100 assets. That's 171% growth in about 5 years. That's phenomenal growth. NetStreet had 163 assets in 2020. Today, they have over 600 assets, 268% growth. What's probably most closely correlated to GIPR is Alpine. In 2019, they had 20 assets. Today, they have about 140 assets, 600% growth in that period. We plan to be in line with our peers and have a growth trajectory which completely outpaces most of our peers. I know the very large net lease REITs have to add multiple billions of dollars of assets into their portfolio in order to achieve single-digit percentage growth in that year. We can grow much faster by adding much fewer assets. So we're just really appreciative that you took the time here. It's really nice to see a lot of names that have signed in here. Bobby and I want to spend some time and answer some questions. And I know that there's a Q&A box here.
Yes, so everyone, you will see at the top of the webinar screen on the Teams platform that there is the Q&A. Again, those are going to be submitted electronically, so please type those in the chat. And as questions come in, please do bear with us as we filter through those and respond. We'll do our best. And of course, again, this is being recorded, so if there's anything that requires follow-up or we accidentally just don't catch here, we certainly will get to you on that. We can see who submits. So as Dave mentioned, the Q&A is open. We'll sit here and we'll observe the questions that come in and answer those. So, but as Dave said, thank you to everyone, and here to answer any questions that are on anyone's mind.
So we have our first question now. Have you successfully closed UPREITs in the past? Absolutely, yes. That's one of the main reasons why we're so knowledgeable about the process. What's even better is that we have fully disclosed documents in our public filings about some of the contribution agreements that we've used with other contributors. Notice I use the word contribution agreement versus purchase and sale agreement. And so we have the ability to make this a seamless and almost effortless transaction for the contributor.
Hopefully no one's being shy.
Another question is, what are some of the tenants you have in the assets?
Great question.
I'll let Bobby take that. Yes.
Thank you for that. So this is a fun question we like to answer. Given our variety of asset classes, we have a really solid tenant mix. Currently, just to name some of the retailers, everything from Starbucks to Sherwin-Williams, 7-Eleven, Best Buy, Lazy Boy, Fresenius. Our office tenants include the United States government in a few of our properties. We have an early education facility, leased by the county of San Antonio. Very solid investment grade credit rating there. Dollar General, Dollar Tree. So it really is largely comprised of credit rated properties, a lot of the household names, if you will. So yeah, it's a really good mix.
Mm-hmm. We have another question is, do contributors get paid dividends? Absolutely. We pay dividends monthly to our contributors, and that's an extremely important part of one of the reasons why your clients or yourself would like to do a contribution, is because you don't have to go looking for that income to replace that you've just contributed to our portfolio. So instead of getting rent from your tenant, you're getting dividends from GIPR. All right, well, we've done a great job, and we're just really happy that you spent some time with us today. I'd like to offer Bobby's email address up there to ask any further questions, and we're always available. We really look forward to speaking to you, and just appreciative that you spent a few minutes with us today.